Hello, I'm back, and this is our third lecture in Chapter 4, picking up on page 129 where we left off this morning. I'm talking to you from my home on a Saturday afternoon, and let's see how far we can get this next lecture, and then I'll probably take one day to give you all a break, not myself so much as you all, because I have been loading you with a lot of information. Okay? Now, when we left off the other day, we were talking about double entry bookkeeping. This is not a history course, so I'm going to just really brush by that very quickly. You won't be responsible for that. But double entry bookkeeping works. No one's ever come up with a better system, and that is what we're about to get into. To take all of the transactions we just saw and see how practically a bookkeeper would enter it into the system, and then the accountant would interpret it and fix it, tweak it a little bit, because the accountant's job is to take the bookkeeper's information from transactions and make them more accurate. Remember, we're trying to avoid material misstatements. The bookkeeper might not know any better, hopefully he or she will, but the accountant most definitely is expected to. So let's see where we go with this, okay? The 4 steps of the whole accounting process is we take transactions and analyze them. We've been doing that already to try to see what accounts are affected and how to get them into the books. The second step is to record them, actually get them into the books. Now, those first 2 steps are what we are discussing in Chapter 4. Later on in the next chapter, we're going to talk about how to adjust. That means fine-tune them. That means the accountant is going to look at them, judge which ones need a little bit of tweaking to make the numbers as accurate as possible and as free of material misstatements as possible. And then the last thing that we do is report them. We pull everything together and send reports to management, to shareholders, to our bankers, everybody. So, friends, know these 4 steps, okay, in this order. This is how accounting works. So 1 and 2 we'll discuss now in Chapter 4, 3 and 4 we'll discuss later. All right, now here we get into a couple of terms, and this is how the flow of accounting happens. Debits and credits and T accounts. All right, there's no joke that accountants, all they care about are debits and credits. Well, really, nothing could be further from the truth. They are simply working terms, and my job here is to clarify that for you. But we do have to focus on the third one, T accounts. What is a T account? Well, every account that we've seen so far, cash, inventory, prepaid expenses, accounts payable, notes payable, capital stock, retained earnings, revenues, okay, all of our expenses, every single one of those is represented by an account in our books. And the easiest way to represent that, now keep in mind that my days in accounting go back to when we did it on paper with pens. Not pencils, you can erase pencils, no, pens, okay? And did it all by hand. Now the computer's doing the same thing. The easiest way to picture that is by use of this crazy little thing called a T account. I'm going to clarify that for you with a simple roadmap. Okay? So first of all, guys, financial information is accumulated within accounts. Once you analyze a transaction, you figure out what accounts to put it into. Not one. Right, you've got to use at least 2 accounts, right? You've got to maintain that balance of that master accounting equation, assets equal liabilities plus equity. And I added a few more, didn't I? I said in equity, we're going to add some temporary accounts. Revenues, expenses, gains, losses, maybe even any dividends that are paid. Ultimately, those temporary accounts get all wrapped up back into equity. I'm going to give you a better roadmap than I have so far to follow. I've used it for years, as have other professors here at the college. Okay, now, we're going to be pumping information into these accounts, and every so often, we're going to find out what the balance in that account is. The balance, okay? Because we want to add up all the increases, I got ahead of myself there, and all the decreases, just like your checkbook. All right. Remember, your checkbook, you start with a certain balance at the start of the month. You add a lot to it. It increases. You take a lot from it. It decreases when you write checks. And then every so often you add all the increases and decreases up and say, how much money do I have right now? Okay, that's finding the balance. All right, so that second bullet point there, the balance for each account will have to be added up and monitored, and every single account, cash, receivables, payables, will have its own T account. When I started my company, even though we were just starting out, I started out with about 200 T accounts. That is what a set of books looks like. And remember, that set of books has to balance. Okay? All right. That means a T account, and I'll show you one in a moment, has to have the ability, if you can picture the letter T, okay, you have to be able to record accounts on the left side and the right side. Now, let's get back to these terms, these crazy little terms, debits and credits. What does that mean? It simply means left and right. That's all it means. If you are in banking, if you've worked as a bank teller, that means something very different at a higher level, debits and credits. But here in this class, for bookkeeping and basic accounting, debit simply means left, credit means right. And if you can picture a letter T, there's a left side and a right side. Okay? Let's go on. Here are some T accounts. I will give you 3 guesses as to why they call it a T account. All right? You've got one for cash, you've got one for salaries payable, you've got one for revenues, rent expense. Ladies and gentlemen, any account that you have in a whole set of books, I don't care if you've got a dozen of them or 12,000 of them, every account can be pictured like that, like you see right up here. But debit and credit, don't let those terms confuse you. Debit is left, credit is right. Okay? Always, always, always. Okay? Any questions? Make sure you write to me, please. I know I'm giving you a lot of videos to watch our first weekend of online education here, but I think you guys are going to jump on this very quickly, and I'm wide open for questions. I've posted a discussion board where you can discuss it among yourselves or with me. Use it, okay? All right, let's go on. Excuse me. All right. Now what we're going to do is we're going to establish a set of rules, guys. Okay. There are certain accounts that increase with a debit, and there are certain accounts that increase with a credit. So certain accounts will increase on the left side, decrease on the right side. That's these. In a moment, we'll talk about ones that do the opposite. They increase on the right side, the credit side, and they decrease on the debit side. Why, for goodness sakes? Because that equation balances. And we have to have a mechanism that balances in order to feed numbers into those accounts. So in these types of accounts, we're going to take anything that's an expense or a loss, anything that's an asset, and anything that is a dividend paid. That's special. Now remember that. Those T accounts will increase with a debit. Why? Because all of them directly or indirectly have to do with a cost of running your business. Okay? In fact, I believe the Latin word debit, the Latin word was debere, and I believe that means cost. Okay? Now, having said that, let me establish the other rules for you, and then I'm going to show you a roadmap to pull them all together. Credit balance accounts. The other accounts I didn't mention, they will increase not on the left side, but on the right side, the credit side. Okay? They will decrease on the left or debit side. What are they? Okay. They indicate sources of funding. Where does our money come from? That's why that equation balances, right? They are going to be liabilities, capital stock, retained earnings. Now, capital stock and retained earnings, you remember, those are equity accounts, right? So liabilities and equity increase with the credit. And revenues and gains, that's the gold standard, ladies and gentlemen. Okay? Revenues make us richer, increase equity. Therefore, it follows the same rules as capital stock and retained earnings. Likewise with gains. That indicates money flowing into us to make us richer. Okay, so please remember these rules, and more importantly, I want you to remember this. have a look. I wrote this years ago. All our accounting teachers here get a copy of this because I'm kind of happy with how it came out. Now you're going to take one look at this and you're going to say, oh my God, how do I read that? I just told you. Okay, now you'll notice that I've drawn the master accounting equation up here, and I've drawn T accounts underneath each one of them. And because there are other accounts that support them, I drew those here. Now all of these, ladies and gentlemen, are what I told you in my last lecture are permanent accounts. Okay, those are going to last. We're going to carry those from one period over to the next, to the next, to the next, year by year by year. In the meantime, we are a revenue and cost generating machine. We are a profit generating machine, and we need a really easy way to do that. So we create these temporary accounts. Those are accounts that we're going to use. They're utility accounts. We're going to use them for a year. Then we're going to shut them off, take everything that's in them, stick them back up here in equity, and start a fresh year. That's how to remember this. Friends, I want you to print this down, or don't print it down, download it. I like to save trees. And keep this handy. Keep this handy, please, for the entire balance of our semester, and maybe into even Accounting 200 that you'll take next semester, okay? Because this is a dictionary about how the flow of accounting for transactions works. All right. Now what I did here is, first of all, I took those three accounts that increase on the debit side, assets, dividends, paid, and expenses. Remember, dividends are not expenses. I drew a T account for them, and you will notice that each one of them increases when you stick a number on the left side. They decrease when you put a number on the right side. Okay, that goes back to two previous slides, debit balance accounts representing costs of different types. Now, and I put it in that kind of ugly, pukish orange pink color, okay? Then I took the previous slide and I said, what are the credit balance accounts? Liabilities, equity, and I broke equity down into two pieces, guys. Capital stock, money that owners put in, and retained earnings, the sum of all of the income, all of the profits that your company has made since it started. Those two things represent equity, and that's why you want to see that number go up, because the more profit you make, the greater this retained earnings number, it goes up to equity, the wealthier you're getting. Now, where do these numbers come from? Okay, they come from business activities. Retained earnings has several things going into it. Now we jump down to the temporary accounts. Dividends, yeah, we'll keep dealing with dividends because you don't have to make dividend payments. Those are distributions of income, but you are in business to generate revenues, and you will have to pay expenses. All right, when we see orange, we don't like that. That's money leaving our company. All right, let's start with revenues, however. Revenues directly feed our equity. Directly. When you make a sale, it's a credit. That's going to come up here to retained earnings as a credit, and it ultimately increases your wealth as a credit. Okay? Now we're going to break the rule a little bit. Expenses, those are evil, those are vile. That's the bad twin of revenues because you have to spend money to make money. The less money we spend, the richer we get, but you still have to spend something. So that's why, friends, we reverse the signs. When an expense increases, that is taking wealth away from you. So when you see a debit down here in the temporary accounts, that is money leaving your company. All of this information will flow uphill to retained earnings. Retained earnings, when you combine it with how much money the owners put in, is where your equity comes from, and that, I think, is a fine explanation of why profit makes you richer. Makes sense, doesn't it? Okay. All right, I am going to post this for you. Make sure you download it for me, please. I beg you. Now let's get back to our slides for a moment. Okay, we talked about debit balance accounts, just as I showed in my roadmap. These are the pinkish orange ones. The credit balance accounts, these are the greenish ones. These are the ones that are our friends. They indicate inflow of funds to us. Okay? So now we come up with a basic rule. In my general example, in my last lecture, I showed you how, given the master accounting equation, certain accounts increase and certain accounts increase or decrease elsewhere, but there have to be at least two. Okay? They can be more than two. They have to balance. So now what we're doing is we're extending this and saying, well, since debits and credits are going to feed our bookkeeping system, do they have to balance? Do they have to equal? Yeah. Yes, yes, yes. So that's why our wonderful Italian monk back in, I think it was 1459 or so, or 1495, said, we're going to call this double entry bookkeeping because if we want that equation to balance, then debits must always equal credits. Debits must always equal credits for any transaction you enter into a modern accounting system. That's it. You break a transaction down into debits and credits, increases, decreases, whatever, those little T accounts, then you have maintained a balanced set of books. I'm going to tell you something else. If you have a computer in front of you, you're a bookkeeper, and you try to enter an account where the debits and credits don't equal, where they don't balance, the computer's not going to let you do it. All these red lights and sirens will go off. Your boss will come running and bring her caffeine shot with her. Okay? That's not good. A computer won't let you post an unbalanced entry. That's why when we go in to make an entry, we've got to make sure it balances right up front. Okay? All right. Read the learning objectives on your own, please. So now I refer to these transactions that we enter as journal entries. And a journal is where you keep all of the transactions that affect a business. It's like a diary, a chronologically oriented diary. You start a business, you're going to keep a set of books, a notebook. It's computerized. I don't care what it looks like, paper, computer. You're going to keep a list of every single transaction that happens permanently in your business. Now, we've seen those already, where we borrowed money, where we paid an employee, where we sold goods, where we bought goods. You've already seen them. All I'm doing now, friends, is I'm formalizing it. Okay? So when one of those entries happens, when one of those transactions, let me say, happens, it causes financial change, and we're going to record that as a journal entry. It is a diary. It is permanent. It has to be there forever, like a Rosetta Stone, okay? And it's going to give you a history, a traceable history for anyone in accounting, in auditing, in management who has to come back and reconstruct something. And it's going to give you the ability to reconstruct any financial event. And that's why I keep saying it's got to be permanent. Okay? No erasers allowed. Don't touch that delete key. All right? Okay. So what we're going to do is we're going to put in a whole bunch of transactions. We're going to do it formally with debits and credits. I'll show you how these journal entries are kept. All right. Now, those T accounts, as you increase and decrease them, are building, they're decreasing, and they've got a running balance like your checkbook. And at some point, you're going to turn everything off and say, stop. It's the 31st day of the month. Now we've got to look at our books, add up every debit and credit. What is the balance in that account? And we're going to call it a trial balance. And this is a proof. All a trial balance is, ladies and gentlemen, is a simple proof that all your debits and all your credits in your set of books equal. One more term I'm going to give you. You're going to look up everything in your books, and that is called a ledger. Okay, a ledger. The general ledger. So you put in all these transactions, increase, decrease, debit, credit. Okay, everything balances, and every so often you prove it. You take your ledger computerized, paper, I don't care, and you add all the debits and all the credits up as balances, that's called a trial balance. All it's doing for you is proving that the debits and credits you have entered equal each other. Okay? And you're going to do that by taking that ledger and producing it. Okay? And this, friends, this is where I'm going to leave you today, is what one looks like. Now let's start with this company called Lawndale Company. Okay? So we have recorded a whole bunch of transactions. Okay? And I guess we'll get to those after. This is a starting point. All right, hold on. This company, Lawndale, appears to be in its 4th year. How do I know that? I told you in class. You look up here, the title of the company's there, the title of the report is there, and the date is there. Okay? Now this is where they ended up before. Okay, so as of right now, we haven't done anything new. At least I don't think. I will verify that for you. But this is what their books look like before we do anything that we just did earlier in Chapter 4 in my previous 2 lectures. Okay? They had. Now these are permanent accounts. They roll over. They already had money in them. Okay? So it's December 29th. Year 4 is not quite over. Okay? So, first of all, they have assets. What do you see for assets, friends? Identify the assets. You see cash, asset. Accounts receivable, yeah, people owe you 50 grand. People have sold you inventory, 65 grand. Now, following the rules I gave you, those assets will all have debit balances. They should. Now, there are exceptions to that. We'll get to that later. But those accounts all have debit balances. Remember, the trial balance is to show you that your books are in balance. That's the only thing it does. Okay? Now remember, that's prior to recording some new stuff, so we're going to record new stuff. Now we move to liabilities. Those usually will have credit balances, as we said in our rules earlier. What do we have? We have accounts payable, insurance payable, notes payable, capital, oh right, that's it for liabilities. Now we move to equity. Capital stock and retained earnings. Stop right there. It says retained earnings beginning of year. This company is about to close its year. It hasn't done it yet. Okay? So as of the start of this year, their accumulated earnings in that important retained earnings account, your wealth by the way, is 32 grand. It is a credit balance. Look back at my roadmap, you'll see it. Okay, now we get to the temporary accounts. All right. So revenues, sales of merchandise, 250, that's a credit. Look back at my rules, look back at my roadmap. Keep that handy, okay? Now we have all of our expenses. We have cost of goods sold, expense, rent, salary, utilities, insurance. Those are all things that we spent to support our sales of 250. Okay? Now, sales of merchandise on down, those are all temporary accounts. Ultimately, we're going to close them all, zero them out, and that will come up to retained earnings. But we're not ready to do that. We've got some more transactions. Prior to recording new transactions, you see it? At the top of in the blue section, prior to recording new transactions. We're going to do that. We're going to update this. All right, trial balance. This is status now, guys. But it's going to give us a glimpse into how we take activity and move it into status. A equals L plus E. Okay? But now, look way down at the bottom here, and you see that the total assets, total misstatement there. The total of all the debits, all right, equals 370,700. The total of all the liabilities, equity, and revenue, there were no dividends, is equal to 370,700. What have we just proven? We've proven that our start point is in balance. So, if we start with a balanced start point and add several balanced transactions to it, then by addition, algebra, the total has to be in balance. If it's not, you made an error. A computer won't let you do that. So having said that, friends, that's a beautiful place to end. I am going to repeat to you, please take this Excel sheet of T-account rules. Make sure you download that and have it handy for everything we do in the next couple of chapters, okay? And you all take care and have yourselves a good weekend. Bye-bye.